You've probably heard it at every family dinner. Buy property. Real estate never loses value. Or the other side. Forget bricks. Just put everything in the stock market. Both sides argue like they have the answer. But here's the truth. Most people are comparing the two without doing the actual math. Today, we're fixing that. We're going deep into the real numbers, returns, risks, taxes, leverage, and by the end of this video, you'll know exactly which one builds more wealth and, more importantly, which one is right for you. Before we run the numbers, we need to set up a fair comparison. Let's say you have $50,000 saved up. That's your starting point. Same money, two paths. What happens over 20 years? Path A, real estate. You use the $50,000 as a down payment on a $250,000 rental property. You take a mortgage for the rest. You rent it out, collect income, and wait for the property to appreciate. Path B, stock market. You invest the full $50,000 into a low-cost index fund, something like the S&P 500, and let it compound for 20 years. You add nothing extra. Same starting capital, same time horizon. Let's see where both end up. Real estate math. Let's start with real estate. Average property appreciation globally is around 3 to 4% per year. In strong markets, like major cities in Pakistan, UAE, or the US, you might see 5 to 7%. Let's be fair and use 4%. Your $250,000 property at 4% annual growth becomes roughly $547,000 in 20 years. But wait, you only put in $50,000. The bank funded the rest. That's the magic of leverage. You're getting appreciation on the full $250,000 while your personal investment was only $50,000. That's a return of nearly 10x on your actual cash. Plus, you have rental income. Even after mortgage payments and maintenance, a well-managed property might give you $500 to $800 per month in cash flow. Over 20 years, that's an additional $120,000 to $192,000 in your pocket. Stocks math. Now let's look at stocks. The S&P 500 has averaged around 10% annually over the last 50 years. After accounting for inflation, it's closer to 7% real return. Let's use 10% nominal. Your $50,000 at 10% for 20 years becomes approximately $336,000. That's less than real estate. But hold on, we're not done yet. Hidden costs. Here's where real estate investors make a big mistake. They count the gains but forget the costs. Property tax, maintenance, vacancy periods when the property sits empty, property management fees if you don't want to deal with tenants yourself, insurance, repairs, and the big one, transaction costs. Buying and selling property can cost 5 to 10% of the property value. That alone eats tens of thousands of dollars. When you factor all of this in, your real estate net return drops significantly. In realistic scenarios, you might be looking at a true annual return of 5 to 7%, not 10 or 15%. Stocks, your cost is roughly 0.03 to 0.1% annually if you're in an index fund. That's it. No tenants, no leaking roofs, no legal disputes. Now adjust the stock return for taxes on dividends and capital gains. Let's say you keep 85% of your gains after tax. Your $50,000 still grows to around $285,000 net. And remember, you invested the full $50,000 from day one. No debt, no stress, complete flexibility. So who actually wins? Here's the honest answer. It depends on your situation. But let me break it down clearly. Real estate wins when you have leverage working for you. You're in a high-growth market, you're disciplined about managing costs, and you want a tangible asset that generates monthly income. Real estate is also a strong hedge against inflation. Rents go up, your mortgage stays fixed. Stocks win when you want simplicity, high liquidity, zero management, and access to global diversification. If you don't have time to manage properties, or you're starting with less capital, stocks are often the smarter move. Consistent investing in index funds has made more quiet millionaires than almost anything else. The truth? The best wealth builders use both. Real estate gives you leverage and cash flow. Stocks give you compounding and liquidity. They're not enemies, they're tools. Use them together based on your income, your risk tolerance, and your goals. So where should you start? If you're early in your journey and don't have a large capital base, start with stocks. Build the habit, build the portfolio, stay consistent. If you already have savings and a stable income, start researching real estate in your local market. Run the numbers yourself. Don't just listen to your uncle at dinner. And if you want to go deeper on any of this, I've made a full video on how to analyze a rental property deal from scratch, and another one on how to build an index fund portfolio starting from zero. If this video gave you clarity, hit the like button, It genuinely helps this channel reach more people who need to hear this. Subscribe if you haven't yet, because we break down money in a way that actually makes sense. The best investment you can make? An informed decision. See you in the next one.